Hi, Nate. Thanks for
Hey,
getting on.
yeah, no problem. Happy to be here.
Right. Well, we're really excited to have you. And I'm so excited for everyone who's watching this video because we are going to get so much great knowledge and experience. Today, we have Nate Sanders from Artifact. And Nate is I've been told he's kind of like the genius when it comes to running a process. And if you don't know what that means, he'll get into it. He'll really talk to us about that. So, first of all, I wanted everyone watching to be able to get to know you and kind of your experience. So, will you go ahead and talk to us about who you are, what your company is, and your experience with funding?
Yeah, yeah. So I'm one of the three founders of Artifact. So I have two founders, Trey and Caleb. I've spent my whole career in product management and product design. And my experience with funding came about really through the fact that this is my first venture as a founder. And I had to learn through networking and through friends and through hard learned lessons what it was like to be able to actually find venture capital and finance our business in an effective way. So yeah, that's a little bit about I guess
Yeah,
myself. I've been here in Utah for about 10 years, two little girls, and we live kind of on the western side in Saratoga Springs,
that's awesome. Your transplant, where'd you come from?
Colorado originally. My wife and I are both from Fort Collins area.
Oh, awesome. So, not too far.
No, yeah, no, very, very similar weather, mountains, all the good things that we love about here too.
That's great. So, you said you've been here for about 10 years. When did you guys start Artifact?
So we started Artifact in March 2019. Previously, I was at Pluralsight as a product manager for a couple of years, and we raised our first angel round in March of 2019. So
Wow.
had started a few months before, and it went a couple months after we went full time. That's when we did our first financing for the business.
That's great. And I don't think you mentioned, but what is it that Artifact does?
So Artifact is a CX forecasting platform. So we take in a company's qualitative data, essentially all the conversations that they have with their customers from across the whole customer journey, and we help them analyze it so they can understand themes, patterns, opportunities, problems, issues really, really quickly across their business.
That's awesome. And I'm sure it's so useful for businesses as well.
Yeah, yeah, that's what we're trying to build.
Yeah. So we have some questions for you, me and our captive audience who's here watching with us today. Um, so I guess let's start first with what is round. So a lot of times you hear in funding or when people are starting a company that, you get your funding in rounds. So can you kind of talk to us about what a round is and what to expect?
Yeah, so there's kind of two sides to how to think about a round. One is the founder and business side, and then the other is the financier side, institutional investors, angel investors, people like that are actually going to be putting their capital into a business. Um, a business, what their concerns are is that they're going to be building and adding a lot of value over the next several years. And so they don't want to give up a ton of ownership or equity into their business for the total amount of capital that they might raise during that time frame, because early on it's really hard to be able to price and size and figure out what a business is worth. And on the financier side, there's a lot of risk to a startup early on. There's an enormous amount of risk around the technical aspects, the go-to-market and business aspects, the people aspects. You even have the right team early on. So there's this structure that has come into place over the last 25 to 30 years, where entrepreneurs and financiers have started to be able to deploy and receive capital in rounds, which are sequenced steps in financing the business. So the earliest round is really focused on the team and the entrepreneur themselves, or at least it should be. And a lot of times that money is coming from family, from friends, or from high net worth individuals like angel investors. And they're giving them just the initial amount of capital to be able to get started, to be able to think about the idea, to be able to start to build some product perhaps. And then subsequent rounds are all about mitigating and identifying the risk that comes with that point or stage of the company's life cycle.
Okay.
So you essentially gain more and more capital and the rounds get bigger and bigger, and it helps you mitigate, grow the business, or mitigate risk and grow the business in a much more progressive way versus just throwing a huge amount of capital at an early business that you can't really size up.
That's really helpful. And I think it kind of gives you a good idea. But a question that came to my mind while you were explaining that is, what do you think like a good timeline for all of that is? Like, when's the proper time to start? Because I've actually heard like once you start thinking about funding, it's probably already too late. Like, get started early. So what would you say is like a good timeline to get even that, you know, like you were saying, the very first one is from family, friends. Like, what would you say is a good timeline?
Yeah, I think it depends, first of all, on like what type of business you have. There are certain types of technology businesses that lend themselves to high growth trajectories that should be taking on capital like venture capital. There are other sorts of businesses that are extremely healthy, strong, and don't necessarily need the capital from a venture capitalist or any sort of institutional firm to be able to grow, even though they might be growing at a slower clip in some ways. So I think, first of all, if I were an entrepreneur, I'd be asking myself, should I even be raising capital at all? Because from the amount of ownership and equity of the company that you give up, if you don't have the characteristics and levers and economics of the business that you're building to actually scale at a really fast rate, then it most likely doesn't make sense to be able to raise venture capital, and you should be building that money off of the cash flows from your customers. That's my first thought is, first of all, establish whether or not you should even be raising capital.
Great advice.
And then I would say that the next thing should be identifying what you're trying to accomplish next. So if you are just very early in trying to evaluate whether there's even, you know, a market that's large enough to be able to explore an idea, probably not the right time to be able to raise capital.
Probably too early.
Yeah, you should probably be doing that, you know, on your lunch hour, like after 5 p.m., you know, at your day job until you've really gotten to a solid spot, or on a sabbatical or something like that, that you could do on the side. But if you have a very clear objective that requires you to be able to be full-time, and you don't have the financing available to yourself to be able to mitigate the risks that are associated with that objective, or even put enough time and energy in it to be able to do it in an effective way, then I think that's a perfect time to be able to start to raise your very first round of financing, which will probably come from angels.
That's awesome. You did mention, you've mentioned it twice now, is how to know, you know, how much power you give over in exchange for funding, right? So how do you balance that? Like, how do you know, or is there a better option for people who don't want to hand over all of the creative, all of the leadership of their company?
Yeah, I think there's two dynamics that power this, and some of these have changed a little bit over the last 3 or 4 years. The first dynamic is there's some market rate that exists that's essentially non-spoken but easily learned values that exist for what dilution should be, or how much money you're actually going to give up to a financier. So early on, your first institutional round, I would say probably your first 3, a pre-seed round, a seed round, and a Series A round, you're most likely going to be giving up 20% of your business. Mm-hmm. And in some cases, it can be more expensive than that. And if you have healthy cash flows early on, it could be much less than that. But that's kind of usually the standard that a founder can expect from the first few early institutional rounds, is they're going to give up about 20% of their business. Okay. So that's the first aspect, is there's just market rates that, like, you know, most of these teams and financiers understand and agree to and are willing to work around. The second, in my mind, is how you actually raise the capital. You know, 10 plus years ago, there's a incubator out of San Francisco called Y Combinator that created a very simplified version of raising capital that is like debt, and that eventually become equity, which is called a SAFE. So lots of founders here in Utah, they raise their first few rounds on a SAFE, which just stands for a simple agreement for future equity. And that document is one of the really interesting contributing and driving factors for founders having a little bit more control in how they raise capital. And what I mean by that is normally when you don't raise on a SAFE or some sort of convertible capital, you end up pricing the round. And what that means is that you have to go through the really heavy, expensive, and time-consuming effort of having your venture capitalist or financier price your business. So figure out what is it worth and then underwrite it and actually do the legal diligence to say, yes, everything that they said is true. We've gone through, we've checked everything. Lawyers have cross-checked everything together. That's a really time-consuming and expensive route to go. Whereas SAFE, the financiers are saying, we are going to give you this capital now. And when you price around in the future, this will convert into equity then. And it allows you to move quicker. It allows you to be able to have more flexibility about when and how you raise the capital. So one way with that context for you to be able to have more control and power over how much equity you give away is to be able to raise capital more progressively and in smaller amounts, but more frequently. So I've seen founders, and this is something that we've done as well, where rather than raising $2 million, they'll raise $250,000. They'll wait 90 days. They'll raise another $250,000, wait 90 days. And the valuation isn't increasing as they go. And they're having enough cash flow from the financing to be able to make progress on the business. So that's another way, is just alternative versions of how to actually structure.
That's really cool. I didn't know that there were, so many different options out there. And I think that's a really great way for people not to have to sacrifice as much as, like, this company's their baby, right? Like, it's something you've created and you don't want to just hand it over to someone else, right?
So
that's a really cool new, I guess, feature of funding. That's really awesome. So kind of shifting gears a little bit, a question that we hear is, what is a process? How do you run a process? What does that mean? So could you help us out maybe with a little vocab lesson? What is running a process?
Yeah. So when that's talked about amongst founders, that's essentially the ability for a founder to be able to structure who they're going to speak with, what order they'll speak to those those investors, and the time frame that they'll speak to those investors, and the general strategy that allows you to be able to step through those things. So the point of a process is to be able to enable you to raise capital as fast as you possibly can in a competitive way.
Okay.
The lack of a process leaves founders very often doing a little bit more searching and a little bit more wandering for capital. So that's why it's critical to be able to have a process in place. But happy to chat more about it if you have questions around there.
Yeah, I mean, no, I think that it does a good job explaining it. And I think that kind of helps, because a lot of times we just hear people have never even heard that phrase. It's new to them. This whole world is new. So it's a really good start for people to be able to know, like, hey, this is what running a process even means. Do you have maybe any advice on the order that people should approach funders?
Yeah, this is something I speak with a lot of new founders about monthly, primarily because I didn't have any context around how to be able to do this effectively, and had to learn from peers and from my own experiences. The first thing I would say is that you want to time box the time frame that you're going to be raising capital in. So you essentially want to be able to set a deadline for and expectations that you want to give investors about when you want the financing to end. And that sounds a little counterintuitive, because ultimately the investors are the ones that give you the capital and ultimately decide like when it ends. But you can set expectations and you can help them understand how quickly you're moving through the process so that things can, faster. So time box it. Second is, I would prioritize and research as many investors as you can. So there are going to be people that resonate with your space and the company that you're building based off of previous investments, their interests, their previous operating experience. They have a thesis on your space. You need to be able to do the upfront research before you ever go out and run a fundraise process, be able to know, who am I going to speak with? So do the research, keep a spreadsheet, do something to be able to understand who you're going to speak with and when.
You did say something about your third point. Did you want to go
Yes.
back and touch on that? Yes.
Did remember. I think one of the other most critical parts of running a process is raising in competitive markets. So we have started to build an amazing ecosystem in Utah. We have some amazing venture capitalists in Utah. The VC firms that have grown and either been started over the last 15 years are really quite amazing firms. But it's also important to be able to realize that there are amazing firms in San Francisco and the West Coast and the East Coast, and there's a higher density of them. And that advantage is completely in the founder's court because it allows you to be able to speak with more investors faster. And there's network effects that live inside of these high competition markets like San Francisco, where investor talks to you one day, he goes to lunch with another investor the next day. Next thing you know, you have 3 investors in your inbox.
Oh, cool.
Those sorts of network effects are real. So one of the strongest pieces of advice I always urge and stress to founders is stop only raising in Utah. There's amazing investors here, talk to them, but go raise in competitive markets because it will absolutely speed up your fundraise process.
That is so cool. Would you suggest, the company's based out of here? Would you suggest flying out there and getting to know them, or would you suggest doing all of that digitally?
Yeah. Our first fundraise, we spent a week out in San Francisco. Essentially what happened is I planned 3 days, Monday, Tuesday, Wednesday, set up investor, meetings for those 3 days, ended up staying until Friday because we had so many extra investor meetings in those initial networking or network effects, I guess, from meeting with investors. So I do think that going to these locations and meeting investors in person is super powerful and effective. Obviously, with the pandemic, that slowed down a lot of in-person meetings. And so I have seen founders do an amazing job. I raised our last round straight from Zoom. So it's still possible to be able to run an effective and efficient process, with these venture capitalists and competitive markets just through Zoom, if that's, a constraint that you have as a business.
Yeah. It's a weird world we live in now where you can't do as many in-person things, but it's good to know that, you still could do all of that over Zoom or virtually.
Yeah. Yep.
So I had a follow-up on your second one. You talked about time boxing and kind of setting those parameters with funders. Do you ever feel like is it kind of awkward? Like, these are the people you're asking for money from and you're giving them deadlines. Like, did you ever feel like that was a little bit of a tight rope to walk?
I think the ability for a founder to be able to, first of all, have a lot of investor relationships that they've been able to reach out to in a cold outreach way. So making those relationships leading up to your financing is important.
Yeah.
So that could be through a listening tour, which is what that's kind of become called, is that you just start to be able to reach out to investors prior.
Yeah.
What that enables you to do in the context of your question is you've built out some relationships and network around the investors that you want to be able to actually speak with. So when you go to raise, you can actually structure it so that you've set up and reached out to enough of them or had introductions to enough of them, that there's a strong enough cadence and enough investment dollars being committed fast enough that you're able to see the end of the tunnel and be able to say, okay, I can see that this is going to wrap up in about 3 weeks. So it becomes a lot more comfortable for the founder to say, look, I'm quite confident that we'll have a lead investor at the end of this 3 weeks, that we'll have terms signed. So would love to be able to keep engaging with you and get an answer here pretty quickly. That's just an effective way for you to be able to help set expectations for them and have those be real-time constraints based on the fact that you've built out a network of strong investors.
That's great. I'm the type of person that I'd be so uncomfortable. Like, hi, here I'm asking you for something, and here I am demanding by a certain date. But I love that you talked about, this isn't your first contact with them, right? Like, this isn't the first time you've ever looked up this company, reached out to them. So it does build kind of that relationship, that investor relationship. So I think that's really important. I guess maybe one last question. You talked about, researching and making sure that you do your homework on these investors.
Yeah.
Have tips on that? Is it all just stalking them on Google, figuring out how would you go about compiling that list and finding the best fit for you?
Yeah. And by the way, I just remembered my third point that I was going to make. So we
That's
can
not a
come back to
problem.
it. But
Yeah.
I think as far as researching investors, there's a couple things that are really strong for resources around this. There are investor lists. Um, One of the, I think, counterintuitive things for early founders is they think that cold outreach, just sending a cold email to an investor, is taboo or not wanted. You have to understand that the entire purpose or goal of investors is to be able to speak with as many promising founders as they possibly can. They are 100% okay and want cold outreach from founders. Any investor who says that they need a warm introduction is a dinosaur, frankly. That's the first thing, is that you can reach out to these folks in a cold email, build relationships that way. If you find folks on Twitter or somebody that you know is a strong investor, reach out to them. There are lists, there are resources and databases that tell you a lot about an investor, and they solicit and offer their information to those databases freely because they know that it's going to bring in deal flow for them. So an example of that is Mercury Bank. So Jason Garcia here in Salt Lake is currently, their head of credit and financing. That company has a database of investors that they keep updated about which stages they lend, or not lend, but actually invest in, the thesis or areas that they want to invest in, things like that. So there's resources like that. But I think the strongest way to be able to make investor connections and to build out that research so you know who to speak with is to speak with other founders. So network with other founders, understand who they love having on their cap table, do some research that way. And that's been the most effective for me. And it leads to warm interest of investors as well.
I think that's a great idea. I wouldn't have thought of that, as go to the other founders, because you kind of almost think they'd want to keep that close to the chest and like not tell you, but that's really cool that the founder kind of community comes together and shares that.
Yeah, absolutely. There's a lot of that. I would say at least every time I've ran around, at least 50% of the introductions that I receive are from another founder.
That's awesome. That's really cool. I think that was the majority of my questions. Do you have any like parting words of advice, or any really interesting parts of your funding story that you would want to share?
Yeah, I think the thing that I would say is don't compare yourself to others. You're going to make mistakes and you're going to learn. From my experience, the first angel round that we raised, it was a lot of searching just for anybody that would be interested in giving us money.
Yeah.
It was prolonged. It went on from December all the way almost until May, of just bringing in early capital and meeting with a lot of different folks. And I learned from that process and that experience to be able to say, okay, I'm going to run a much more efficient process this time. And we got a term sheet the next time we raised in 2 weeks. Our most recent financing that we had in December took 9 days. And so there are things you're going to learn, and just be patient with yourself, understand that it's a learning process, and understand that there's founders like myself that are absolutely willing to be able to help and listen and give some advice. So reach out.
Yeah. Well, what's the best way for them to reach out? Is it LinkedIn? Is it email?
Yeah. They can reach out to me on LinkedIn. I'm happy to be able to set up a time to be able to chat with them from there. But yeah, LinkedIn's great.
That's very nice of you. And I hope that, people do reach out and you can kind of help them in their journey, because everyone's starting at a different location. And, it's great to know that there is that founder network where founders are helping founders.
Yeah, absolutely.
Thank you so much for your time. And I'm really excited to see what Artifact keeps doing.
Yeah, us too. Yeah, we're excited for the future, and there's a lot of exciting things ahead, and happy to chat.
Great. Well, thank you so much. And we hope to talk to you soon.
Sounds good. Thank you.
Bye.